Hello, my name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning. I've been an inheritance tax specialist for more than 18 years and we've helped hundreds of clients save millions of pounds on their inheritance tax planning and implementation. So today's video is around pensions and pensions in trust, and our recommendation to place your pension in an additional trust and why that is. Hi and welcome back. So today's video is around why should you place your pension in an additional trust. So as you're aware, if you've got a normal pension scheme in the UK, it's already held subject to a trust. So if you die before age 75, your pension is payable out to the beneficiaries, your named beneficiaries of your pension plan, free of taxes. And if it's post 75, they then pay income tax on anything they take out based upon their normal tax rate. So that doesn't change. So why are we suggesting that if a pension's already in trust, that we place it into an additional trust? So what we're talking about is the death benefits of the pension. So effectively, if a pension and you die pre-75, that pension would go into a separate solicitor written trust. Okay, so what's the benefit? Well, basically that trust has the power to lend money to your beneficiaries. So say you've got quite a big pension plan, 500,000 and above, and you're still in your 60s and it may be another 15 years or so before age 75, and it may well be that you may never touch your pension because your assets are big enough and you think, well, actually I could pass this pension on to my children free of inheritance tax. It's a perfectly viable strategy for people who've got personal pensions, and may also be a viable strategy for people who've got final salary pension schemes. That's a different question. However, if that pension and you died before 75, the money would then go into this external trust. It would go in free of tax, and because that would be the beneficiary of your pension. And then what the pension scheme could do is pass the money on to your spouse as a loan. Now, if, for instance, that pension is worth whatever, £500,000, and let's ignore growth, but it would still grow in the trust in the same way as it's grown before. You pays your wife out £50,000 a year. She takes the £50,000 out, and effectively over 10 years, that's all the money come out. Let's ignore the growth for the moment, right? Now, she owes that pension scheme £500,000 because it was a loan. Now, that means when she dies, that money is payable back to the pension. What you just did was reduce the value of the estate by £500,000, thus saving potentially £200,000 of tax. But also the money could go on to grandchildren, it could go on to other people. It's very, very flexible as to how the money's pulled out, and even post 75 there are some significant advantages for that. But basically the idea is if you die before 75, monies can be paid out as loans rather than directly to the surviving spouse, thus reducing the inheritance tax. So I hope you found that useful. If you did, give us a thumbs up and a like. But thanks for listening, and goodbye for now. Bye.